What if I told you the single greatest obstacle to building wealth isn't a lack of money, but a lack of patience? In a world that screams for faster, bigger, and now we've been sold a dangerous fantasy that the fast lane to financial freedom is paved with huge, bold investments. We believe that if we just had more to put in, we'd get rich quicker. It's the logic of brute force, that more input must equal more output. But this idea is a fragile illusion, one that ignores a force of nature far more powerful than the size of your bank account. It's a force that works silently, in the background, often misunderstood and almost always underestimated. This force is the quiet engine of all true, lasting wealth, and it has very little to do with how much money you start with. In this video, we're going to dismantle the myth that investing more makes you rich faster. We're going to explore the hidden architecture of wealth, look at why a small, consistent effort can outperform a massive, frantic one, and uncover the fundamental truth that Wall Street often forgets to mention. We're going to talk about compound interest, but not as a boring math formula. We're going to talk about it as a law of the universe. It's the idea that your money starts making its own money, and then that money starts making money, creating a chain reaction that can turn dust into gold, but only if you give it its one essential fuel: time. Most people see investing as a race. The person with the fastest car, the biggest pile of cash, should win, right? The common wisdom is, if I could just invest $10,000 a year instead of $1,000, I'd be a millionaire in a fraction of the time. We build entire financial fantasies around a future lottery win or a surprise inheritance, believing that a huge capital injection is the only thing standing between us and our dreams. We see the headlines of overnight crypto millionaires and assume that's the blueprint. All you need is a big bet. To support this view, we look at basic math. 10% of $1 million is 100,000. 10% of $1,000 is only 100. The conclusion seems obvious. More money makes more money. It's simple, it's clean, and it feels undeniably true. Our entire culture reinforces this. Go big or go home. Fortune favors the bold. We're told to be aggressive, to seize the day, to put it all on the line for that one big score. But if it's really that simple, why do studies show that nearly a third of all lottery winners end up bankrupt? Why do we all know someone who inherited a sizable sum, only to have nothing to show for it a few years later? If the amount of money was the only variable that mattered, this should be impossible. And this is the first crack in the myth. What if the amount of fuel you pour into an engine doesn't matter if the engine itself is broken? What if the real secret isn't the size of the investment, but the design of the system it's placed into? To understand this, we need to stop thinking in terms of addition and start thinking in terms of multiplication. We need to look at the world through the lens of compound interest. Let's imagine two friends, Alex and Ben. Alex starts investing at age 25. He's just starting his career, so he can only afford to put away $200 a month. Ben, on the other hand, decides to wait. He wants to enjoy his 20s, and he figures he can just invest more later to catch up. So at age 35, 10 years later, Ben starts investing. And to make up for lost time, he invests $500 a month, more than double what Alex does. Now, conventional wisdom says Ben should win. He's investing more money. He's applying more force. But let's fast forward to age 65. Alex, who only ever invested $200 a month, has over $1 million.